The SmallCap Fintech Company Oppfi was recently chosen as the #1 top pick for 2025 from Seeking Alpha's Quant system. The company could grow insanely fast over the last year, with their net income and adjusted EPS being up by well over 100% in this time frame. And even though they are still a very young small cap, they are already thinking about their investors and have started to return money to them via share buybacks and even dividend payments, which sets them apart from many other younger growth companies. So in this video, I want to see if they can continue this trend and are also a good long-term investment. For that, I will have a look at their business models and markets, look at their latest financial statements, and also check the valuation to see if now is a good time to buy. So sit back, relax, and let's explore Oppfi's investment potential together. My name is Florian, welcome to Cashflow Maniac. Since their IPO on 20th of July in 2021, Oppfi has underperformed the S&P 500 a bit despite the recent rise in stock price. In fact, they have been trading below their IPO price from July 2021 until the beginning of January, and the stock has just got traction very recently after the webinar and article from Stephen Kress. And speaking of Stephen Kress, he is the vice president of Seeking Alpha's Quant strategy and market data division. He is, in fact, the creator of Seeking Alpha's quantitative stock rating system and also of many other analytical tools on the website. At the beginning of every year, he introduces the top 10 stocks that his quant rating system recommends for the year. So these recommendations are purely based on these algorithms, and there are no emotions or personal opinions involved. On the 9th of January, he published his list for 2025, and when we scroll down a bit, we find the top stock for 2025, which is the SmallCap Fintech Company Oppfi. As of this recording, Oppfi is still the second highest ranked stock by quant rating in Seeking Alpha with 4.99 points out of the maximum 5 points. Before his article, I had actually never heard of this company before, even though I'm actively screening for small caps. So naturally, he got me pretty intrigued and I started to take a deeper look into them. And to understand their full potential and why they are so interesting right now, we first need to understand what exactly they are doing. Oppfi is essentially a technology platform that connects community banks with customers who are seeking credit but are turned away by other options. They are trying to educate the customers to build financial health through transparency, good customer service, and responsible lending. And as a fintech, they are doing this with a technology and AI-driven platform by using data analytics and machine learning to assess the loan applications quickly and automatically. The original loans are not issued by Oppfi, but by their partner banks. But Oppfi may buy back the loans or a portion of it later to still benefit from repayments and fees. This operation and construct is necessary so they can avoid being classified as a direct lender. With their main product OppLoan, they have already processed more than 40 million applications, from which they have served more than 2 million customers. And the numbers are growing. The company estimates that they have the potential to reach more than 60 million customers in the US where they are operating, who either have no bank account or can't get access to loans due to various other reasons. And they are able to address this large market because their platform enables their usually more locally oriented community partner banks access to a large and nationwide audience that they could not address otherwise. So they form, as they put it, a symbiotic relationship with these banks. And they don't stop at consumer loans. Earlier last year, they acquired a strategic 35% share in equity interest in Byte Advance with the option to obtain a majority or even total ownership of them over time. This is particularly interesting because Byte operates with a business model that is very similar to Oppfi, but instead of targeting consumers, they focus on small businesses. As Craig Hacker, the CEO of Byte, stated, their mission is to simplify the funding process and give small businesses the financial support they need to grow. And they do this with quick and flexible short-term financing with terms that typically range from 3 months to half a year and fundings between $2,000 to around $250,000. Their revenue-based financing models gives their customers and especially businesses that face troubles in securing traditional bank loans a great deal of flexibility. So both companies complement each other very nicely, and Oppfi wants to help Byte to scale this even further by implementing their data analytics and automation tools. And there is definitely a huge market for such solutions. The Consumer Financial Protection Bureau estimates that the market for small business loans from non-banks is roughly 550 billion per year. And almost 75% of these loans for small businesses are below the $250,000 mark, so the majority of this falls exactly into the category that Byte is serving. And on top of that, the number of community banks or credit unions is shrinking year over year. Keep in mind that these banks primarily operate locally. So as a result, it becomes increasingly difficult to bring together these banks and the lenders by traditional means. And all this comes at a time where consumer debt in the US is at its highest level ever. All this paints a very positive picture for fintech services like Oppfi and Byte. The overall TAM, the total addressable market, is huge, and there is a lot of room for growth. Elite Research estimates the compounded annual growth rate in this fintech lending market to be over 27% until 2030. And we can see from the numbers here that they expect this industry to reach 10 times the value it had in 2020. One of the main reasons for this is that fintechs can reach a broader market than traditional banks. While traditional banks rely on credit scores when determining who gets a loan and who doesn't, fintechs have access to much more data with their data collection and deep learning tools. This allows them to better analyze the risks and extend their financing options to a larger pool of users. And they can process this data from both banks and lenders more easily and quickly, so their customers spend less time on document collection and verification. This makes it much easier to use for all parties involved. But despite, or maybe because of these advantages, this fintech market is a highly competitive one with many active players like Lending Club, SoFi, Upstart and even PayPal to some extent. The entry barriers for this industry are not too high, and in addition, the many competing services make it very easy for customers to compare or change their providers. And while Oppfi's data-driven approach gives them an edge against traditional banks, when competing against other fintechs, I don't think that their moat is too huge. But that hasn't hindered the company from growing quickly over the last years. Usually, I am looking at the 5-year growth numbers here, but as the company is only listed on the New York Stock Exchange since mid of 2021, I'm using the 3-year numbers today. And over these last 3 years, the company could grow its revenue with a CAGR of almost 2% annually and their free cash flow by 23%. The EPS declined by a huge 44.8% though. And one of the reasons for this was that in 2021, the earnings per share was quite high. But these numbers here do also not include the latest numbers from 2024 yet. So let's also look at the latest quarterly report to get a more current picture. And this is where it gets pretty interesting. Because in the last year, the company could stop its downtrend in EPS and increase it again by 112%. This is still not on the same level as 2022 or even 2021, but at least the trend is pointing upwards again. And what is even more incredible is that the company could increase their net income by over 100%. And remember, their revenue only grew by 2%. So they could translate a top-line growth of only 2% to a bottom-line growth of 116% year over year. And the projection for the full year 2024 points to record revenue as well as record levels in adjusted EPS. And because of the acquisition of 35% of Byte that is also profitable already, these EPS numbers already partially include the earnings of them. The same is actually true for most other metrics. Oppfi could grow all of them very quickly in 2024 with mostly double to even triple-digit growth rates. And at the same time, Oppfi's free cash flow generation has improved dramatically over the past year and is also up by more than 2.2 times from the number that they had in 2023. And I think that their use of this free cash flow was pretty smart, with a payment of a special dividend, the acquisition of Byte's share, lowering the debt level, and even share buybacks. So even though they are still a very young company, it seems like they have their investors in mind and are trying to reward them. But the dividend they paid was a special dividend, so there is no guarantee that they will continue paying one. I still find it a very good sign that their management is already thinking in this direction. This huge free cash flow growth has also pushed the free cash flow yield to incredible 52%. The EBITDA margin is with 24% also not too bad, and only the return of invested capital is slightly negative. But the company is still very young, so I think that we will see quite some fluctuation in these numbers over the next years. At least with them lowering the debt level, they are currently sitting at a total debt to EBITDA ratio of 2.6 and a long-term debt to EBITDA ratio of well under 1. And combined with the incredible share dilution of minus 3.4% per year over the last 4 years, they show a great balance sheet in general. It is actually quite rare that a company can grow at such a quick pace and even acquire another company while at the same time lowering the leverage and even buying back shares. So I have to give huge props to Stephen Kress here that he dug out and shared this find with us. But now the question is, of course, can they continue this trend? Or was last year just an outlier for Oppfi? At the moment, there are only 2 analysts who cover the company, and they give a 1-year price target of $10 and 10.50. And this was already surpassed when the stock price shot up in the last few weeks. Their EPS growth is expected to be a bit over 16%, which is well below the numbers from this year, but still a growth, while the revenue is expected to grow with 11.2%, which is around triple the value from last year. I am actually very curious to see how this increased revenue growth will translate to net income growth. The estimation of Market Screener is that the net income should grow with 6.45%, which is well under the number of this year. But then we can hardly expect a top-line growth of well over 100% every year. With this kind of growth for a US company, I would usually expect the valuation to be quite high. But that's the beauty of small caps, because here we can find such gems at a reasonable price. The forward PE ratio of the company is with 12.3, much lower than the average of the S&P and also a bit below the sector median. Unfortunately, the company didn't report their EBITDA, so I couldn't calculate the metric here. And because it is a small cap, some of these forward-looking values are also not available. So for price to cash flow and PEG ratio, I used the values from the trailing 12 months. The price to cash flow is with 0.75, not even close to the sector median of 10.3, and so is the PEG ratio of 0.04. If you haven't seen last week's video where I explained the PEG ratio in more detail, this basically puts the PE ratio in relationship to the company's growth. So it tells me if the valuation of the company is in line with its growth or not. According to Peter Lynch, one of the best investors of all times, a PEG ratio of under 1 indicates an undervaluation, while a PEG ratio above 1 indicates an overvaluation. In reality, we also have to see this in relation to the sector, which in this case has a PEG of 0.68. This is also on a trailing 12 months basis, so the reason why it is so cheap is the huge growth from last year. When I use the much lower growth expectation for the next years, the PEG ratio on a forward-looking basis should be closer to 0.75, which would still be a very good value. And compared to their own history, the valuation seems to be a bit high on first glance. Especially the price to cash flow ratio is 3 times as high as their 4-year average. The average of the PE ratio is still a bit lower than the historical average, but the curve is pretty fragmented here. And as a small cap, the volatility of these numbers is also pretty high, so in this case I would take these values with caution. All in all, the company still seems to be valued at a reasonable price, even after the huge increase in stock price. So the last thing remaining before we sum this up is the direct comparison to their peers. But before we go there, if you find this video interesting, please subscribe to the channel so you don't miss out on my next analysis. As a small channel, this really helps me out a lot, and we are so close to 500 subscribers now. So thank you very much. For their peer comparison, I choose Upstart, SoFi, as well as PayPal as a bigger player. The total returns from this peer group over the last 3 years didn't show too much to speak of. But since the last quarter of 2023, Oppfi is pulling ahead of their competitors and has by far the best performance by now. SoFi could still return almost 30%, while the stock price of Upstart and PayPal even declined during this period. None of these companies is paying a regular dividend, so there is nothing to compare here. But it gets interesting when we compare the valuation. Even though Oppfi had the best performance in this admittedly short time frame, at least from the perspective of a long-term investor, their valuation is still the cheapest of this group. And even when we look at the forward PE in 3 years from now, Oppfi has still the lowest multiple from this group. But over the last 3 years, SoFi could grow their revenue the quickest, with PayPal coming in at second place. Still, when we look at the EPS growth, Oppfi takes the crown from this peer group. All in all, I definitely like what I see with Oppfi. And especially their attempt to widen their business model to small business loans with their partial acquisition of Byte has a lot of synergy potentials that the company should be able to leverage in the next years. I also like their capital allocation strategy and that they are thinking about their shareholders already by buying back shares and even paying a special dividend with their excess cash, of which they could generate quite a bit last year. So I think that they might become a very strong player in this quickly growing market. And there is also still a lot of room to grow with the huge combined total accessible market for consumer and small business loans. But we should not forget that they are a small cap. And small caps have a higher volatility and a higher risk compared to larger companies. I also don't think that they have a huge moat that sets them apart from other fintechs in this lending space. And for a long-term investment, I prefer to have companies that have a wide moat because you never know what will happen. But that is just my opinion. So what do you think about the company? Do you like it? Or do you see any risks that I maybe missed? I would be really interested to hear your thoughts down in the comments. And please, before investing, do your own research and only use this video as a starting point for your own analysis. One of my top picks for 2025 is actually the semiconductor company Monolithic Power. And if you are interested in a full analysis on them, well, you are in luck because right here you can find a full analysis on them that I just posted last week. That being said, thank you so much for watching, guys, and see you in the next video.